Hey everybody, it's Larry Berman here. Another really incredible week. Lots to unpack this week. So let's take a very quick dive into the chart room and see what they're telling us. So I want to start looking at the semiconductor sector because when the 50-day moving average broke for the broader market this week, we saw really a break in the trend in semis. All should know that semiconductors have been the leadership. We had some negative news out of ASML this week, and that really, to me, was the trigger. Obviously, there was a bunch of Fed speakers pushing back on interest rate cuts, and there was a lot of discussion around not cutting. I think there was even one Fed governor this week that talked about maybe even having to raise rates again. I don't think that that's on the table, and I doubt very much the market would even look on that side of pricing and rate hikes at this point. We would have to see 3 or 4 more very, very strong inflation numbers. And when I mean very, very strong, I mean very, very strong, not just stabilization or a little bit of a bounce in the next few months for the market to do that. So I don't think we're going to see that, but it's pretty clear to me the message is getting through that the market was way too aggressive in pricing and easing. And at this point, as we've said for the better part of a year now, you need a hard economic landing for the Fed to get accommodative here in terms of aggressively easing or even starting the process. So with the markets breaking in the charts, you got to always look at the leadership. So where is the correction going to come here now? Now, clearly, if you look at it, you see the rising 200-day average now that the 50-day average broke as pretty much a no-brainer. Again, projecting that trend line out, if you do that a couple weeks into the end of earnings season, another 10% for semis. You can do the same kind of an analysis on the NASDAQ. So on Friday for the SMH, we wrote puts out for a couple of months, earning some premium to buy the SMH in the 170 range. So I'm looking for a trade through the 200 as an opportunity to add. On the NASDAQ, that equivalent level was 370. So again, about a 10% overall correction in big tech, NASDAQ semis from here. To me, before the valuation is not egregious, and if you want to join the trend, that's where you do it. So we did those option positions on Friday into the weakness towards the end of the day. When you look at the interest rate impact of what's happening here, TLT, 30-year yield, you had a rally overnight on the Israeli bombing in Iran. Iran very quickly seemed to walk that back as a non-issue for them. Make no mistake, it is not a non-issue. Iran and the leadership in Iran have the sole mission of trying to eliminate Israel's being and Jews in general from the planet. If you don't understand that narrative, you don't understand the Middle East and what's gone on largely for the last 40 years there. There was a much broader effort among the Arab nations back then in the 60s, 70s, and coming out of World War II, and there were a bunch of attempts. But in recent years, with the Abraham Accords and several of the Arab nation recognizing Israel's right to be, Iran is the whole standout there. And, I don't think anything short of a regime change in Iran changes that. But Israel will wipe out Hamas from Gaza. They will not stop short of that. And until that happens, could be 6 months or a year still, the tension is in the Middle East will have an impact on the energy markets, temporarily last night, but there's more to come here. This isn't over yet. What does it mean? It means safe havens still have this underlying bid, or ought to. Treasuries are part of that. So we saw the rally in treasuries, but as soon as that came off, we now worry about the quarterly refunding and the deficits and the debt and everything else around inflation. So the long end here is still stressed. I didn't think we would see the 10-year and the 30-year get back above 5%. And the key to that is the quarterly refunding announcement, the initial size of the need on the 29th in the afternoon, and then the composition of that in the morning of May 1st, the FOMC meeting day. So that was the big inflection point back here at the November 1st. So you had the QRA, the initial announcement on size, that was thought to be negative. Janet chose to do it all with bills, and that ignited the risk-on rally that we saw in the fourth quarter, only to be met by 4% yields where the risk return is not compelling at all. So we've extended the duration in our bond portfolio last week significantly. We're now back at a benchmark duration for our bond holders, people in our bond fund, where we've basically held a money market risk. And so we have a bond fund this year that has a positive total return compared to the vast majority, well, everybody else out there. Nobody's got a positive return in bonds this year. And if they do, send me an email on it, because I'd like to see who it is, because maybe they're doing some of the same things we are. If we get back above 5% again, that will be our next trigger to really get aggressive, because the higher for longer message means to me hard landing. So what did Janet do with yields backing up now at the quarterly refunding? There's a good chance that she decides to fund a lot of the next quarter's need more with money markets than with coupons. That could trigger a bit of a risk-on rally. So I think that's something we need to be mindful of in the next couple of weeks. So far, earnings, slightly better than expected. We've got a lot to unpack in the next 2 or 3 weeks of earnings before we get comfort there. But the valuation of equity markets, specifically in the tech area, we're getting some of that deflation now. You got to love tech long term. You got to buy into the dip. And the question is always, what are those levels? What I highlighted just in the previous chart were some of those levels where we're looking to get in. For the S&P 500 overall, again, technical break this week of the 50-day. We've been very cautious for weeks and months even. And so, again, where is this correction likely going to take us to? Probably at least this first Fibbo, maybe the rising 200-day or the 50% retracement. It's all or highly levered to what Treasury does in terms of pressure on the long bond, what the next inflation report says, what the next job report says. But really, when you think about it at the end of the day, the market didn't break here. So this is April 9th. The CPI report came out the morning of April 10th. So this was the last day to trade. And whether it was value or growth, so we got the mega cap value ETF, the mega cap growth ETF. They were both having very good years, and they both broke on the inflation number. And as you see where they go now, interestingly, this week, that the mega cap, the expensive part of the market versus the value part of the market, we saw an inflection where value now is beating growth this year in the US market. So a lot of interesting dynamics here. Just to summarize here for everybody, getting back to, how do you deal with this in your portfolios? I mentioned a couple months ago when valuations started to get ridiculous that I shifted all my investments this year into privates, private equity, private debt. Last week, last month, I'm making money. I'm in an asset class where it's not risk-free by any stretch, but the exposures that I have this week, actually, we attended Northleaf's annual investor conference for private debt and private equity. And the keynote speaker on a, I guess it was more of an interview format for that, was John Graham, from the head of Canada Pension Plan. So for all Canadians, what is Canada Pension Plan doing? They have about 60% of their portfolio now in privates. So why would you do that? When you look at the market capitalization of the world, public market capitalization and private, it's only 10% of the investable universe that's in the public market sphere. 90% is private assets. And if you're ignoring the private assets as a source of driving returns to your portfolio, you're missing out on the biggest part of the investment universe. And so I love privates. They should be more parts of your portfolio. If they're not, have a look at Q Wealth and find an advisor in the Q Wealth network, and they can help you get invested and utilizing this extremely important asset class that the smartest pension managers in the world are investing in. And the risk returns are compelling compared to the volatility that comes from time to time in the public market portfolios. Have a great week, everyone.